Jason, it's great to be here. A lot of interesting things going on, so I'm looking forward to the interview.
Me too. So before we talk about gold, silver, and the gold and silver miners, let's talk about the oil market and the oil price. So right now we're at WTI crude $47.57. We're at Brent crude $50. Do you think the oil market is acting very strangely right now?
Yes, I do. Yes and no. Let me start by saying I believe the oil price will continue to fall. And that's according to new analysis done by the Hills Group. It's basically a study on the thermodynamics of the energy available in a barrel of oil. It's continuing to decline. So if you have a car that's brand new, you're going to pay $25,000 for it. Well, let's say the car is 15 years old. You're not going to pay $25,000 for it. You're going to pay about $5,000 for it. Why? Because all the embedded energy in the car, in the engine, and the electronics are all wearing out. So it's not worth top dollar or a brand new price. The same thing is going on with the price of oil. So what happened was we hit a high because of the money printing by the Fed and central banks. The price of oil went above $100 for 3 years, and now it's fallen off a cliff. Now, we may see volatility going on, Jason. We could see a spike up if there's a black swan event or hyperinflation. But according to this new analysis I'm looking at, the actual price of oil will continue to decline because the value of it it takes so much energy now to produce this oil. It's not worth it. And we're starting to see it in the financials. And that's one thing I'd like to cover because the financials of the top U.S. oil and gas companies are in really bad shape. Matter of fact, they made money years ago when the price of oil was $45. They were making profits. They're not making profits when the price of oil was at $45. So I'd like to discuss this even more.
Yeah, the oil companies, their balance sheets, the larger ones like ExxonMobil, Royal Dutch Shell, BP, Chevron, for many years now, Steve, they've been buying back their stock a lot. They've been spending billions of dollars, ExxonMobil especially, buying back their stock rather than focusing on replacing reserves with low-cost reserves. A lot of them are transitioning from oil production, mostly oil production, to natural gas production. But, one thing about the oil, you said the oil price will go down. I agree with you, the oil price will go down in the short term, but I think it's for different reasons. I think in the next 12 to 18 months, I think all the players now, Steve, of lots of whether it's national oil companies, whether it's Saudi Arabia or Libya, or large oil companies like Royal Dutch Shell and offering more oil production, this is a head scratcher to me, Steve, that, these companies, you would think in more of a free market dynamics, they would want to cut production when the oil price is falling, and yet here we have evidence of all these players in the oil market, especially the governments that are not free market entities or national oil companies. When the oil price goes down, they need to increase oil production to make up for lost revenue. So it's kind of weird what's been happening in the oil market lately.
I agree, and I call this. You see, I don't look at the markets quarterly like a lot of analysts do. They look at what happened this quarter, the cash flow, the incomes, financials. Or next year. I look at it as an ongoing trend. And the ongoing trend for me says, according to this new analysis, that the U.S. and global oil industry will start to disintegrate. And the reason for that is, and last year was a perfect example, according to the International Energy Agency, the world only discovered 2.4 billion barrels of oil. See, that's bad news because we burned 25 billion last year. So we only replaced less than 10% of what we consumed. Now, according to their stats, the average every year for the last 15 years has been 9 billion barrels. Well, they say we're consuming about 24, 25 billion barrels of oil, conventional oil, every year for the last 15 years. It's the unconventional that we have been growing. But we've only replaced about a little more than a third of conventional oil in the last 15 years. So we're consuming 2/3 more than we're finding, and this is an ongoing trend. And now last year was at a low. Matter of fact, you got to go back to the 1940s to find a year that the world found this little oil. So now I want to say one thing. What's interesting, I looked at the data for the top 18 U.S. oil and gas companies, And what's interesting, Jason, is their debt has increased from 106 billion in 2008 to almost 194 billion. Now, why is that? They made $100 2012, 11, 2012, 2013. Why is their debt increasing if they made lots of money producing this oil? The reason is they weren't making money. Some of the top ones were ExxonMobil, Chevron, but when you start looking at their capital expenditures and then their free cash flow and you take out dividends, this is the clincher. In 2011, Chevron, ConocoPhillips, and ExxonMobil, they had 27 billion left over after they paid their capital investments. Last year, they spent 29 billion more on capital and dividends than they made from their operating cash. Now, that has made their long-term debt double since 2014. Now, that's not sustainable. So even though, as we mentioned, we talked about prior to the interview, that costs are falling for the oil and gas industry in the United States, and a lot of these companies are going into the Permian. That's the new fad now. Because I'm looking at data on the back end in Eagle Ford. The back end of Eagle Ford is down like 800,000 barrels from their peak. Even though the Eagle Ford has increased a little bit in Texas, with the more rigs are coming on since the low last year in U.S. oil production, there's no real growth in the back end in Eagle Ford. The growth is in the Permian and some other places. So even with this huge increase in the drilling rig count over the last year, the back end in Eagle Ford really hasn't seen much of an uptick. So I think going forward, I believe the U.S. oil industry will disintegrate within the next 10 years. It'll never come back because the quality of oil that we're drilling now, it's just not profitable. It wasn't profitable at 100 for most of the shale companies. So it's not really profitable at 50, even though costs have fallen. So going forward, I see a huge problem for the U.S. economy because our domestic oil production is going to decline. I would say within 10 years, U.S. oil production will be down between 60 to 75%.
It seems to be a tension for me. Basically, what I've been told, speaking to oil experts and a lot of persons, is that Wall Street views the Permian as it's not as risky as a water well where you could spend millions of dollars and drilling underneath the ocean floor and you hit dry holes. But if you're lucky, you can hit a gusher and the thing could flow 50,000 barrels per day for decades. They would rather have the certainty and not risk dry holes. So they're funding these extremely marginal, unconventional Permian plays, which cash flow immediately. But like you said, they can peak really quickly. So the Bakken and the Eagle Ford, they weren't even running for a decade really. I think, maybe they ramped up a little bit in 2007 or so before the 2008 financial crisis, and then they dropped during the 2008 financial crisis. But, these wells, a lot of them haven't even been running 10 years, and they've already fallen off a cliff. And those sweet spots in the Bakken and the Eagle Ford have already been drilled. So they can put more and more rigs there. I was going to bring that up. We're actually at a 20 months high rig count in the U.S., which means that it's surprising, considering the oil price, that you would see more people wanting to drill. So that's why I asked you at the beginning of the interview if you were surprised that despite these low oil prices, we're seeing record amounts of rig counts. We're seeing a lot of OPEC countries willing to increase production. We're seeing Mexico desperate for revenues, willing to do deep water drilling now at these prices. So it's a very interesting oil market. People are desperate for, I guess, any type of cash flow.
Yeah, as I mentioned, I call it the going out of business sale. This is what's going on. The U.S. and global oil industry is in what is known as the going out of business sale, and so they can't make money. Or they're making a little bit of money. And you brought up Saudi Arabia and Mexico, two perfect examples. Things are not just bad in the U.S. They're bad all over. Look at Venezuela. They're in hyperinflation and they're eating dogs over there now. Now that's ironic because Venezuela has the largest supposed oil reserves in the world. The problem is those oil reserves are heavy oil reserves. Now, I would guarantee you, if Venezuela was holding on to the world's largest light sweet crude like it was in Saudi Arabia, they would not be in this predicament. Yes, they have corruption because of their communist government, as well as corruption in the state-run oil company. But if they were sitting on a record amount of light sweet crude, cheap to produce oil reserves, they would not be in this predicament. Because there's a lot of corruption going on in the Middle East in their governments, but they have the light sweet crude, it's cheaper to produce. That being said, because the price of oil has fallen, it's gutting Saudi Arabia too. And in an article I wrote that Saudi Arabia has liquidated 34% of its foreign exchange reserves since 2014, 2.5 years. And most of those are U.S. Treasuries. They're not making the money. Now, what's even more interesting, in the last 2 months, January and February, as the price of oil has increased, they actually liquidated $10 billion more of their reserves, foreign exchange reserves, in January, and $9.8 billion in February. Why are they continuing to liquidate reserves if the price of oil has recovered from the low of 30 in the beginning of 2016 to now 50 in the beginning of 2017? The reason is they're in big trouble because it's very expensive for them to produce their oil, to continue capital exploration and expenditures, and also to fund the government. They are in serious trouble. And the U.S., you know, they're literally bankrupt. They're technically bankrupt. A lot more liabilities than they have in assets. And production is down 35%. They had to pay last year. Well, they couldn't even pay it because they didn't have the money. So they had to either sell an asset, they had to sell stock, or they had to borrow more money. And so they go further into debt. Now, this is not sustainable. I don't care if the drilling rig costs have declined 50%. And the reason why they have these lower costs is because most of it is doing to the gutting of the oil service industry. They're just putting rigs out. They're renting rigs out just to stay alive, and they're doing it at 50% the price or more in price than they were 2-3 years ago. So this is not sustainable either. So I think people need to look at what's happening with the financials in the U.S. and the global oil industry, and when you see only oil disruption used to replace our existing production can't continue to do
the consumer can't pay for high oil prices. U.S. can't afford to pay for $4 a gallon, $5 a gallon, or higher oil prices. But yet, a lot of these economies are built. They need higher oil prices to make money. So Venezuela, if the oil price was $100 a barrel, still with their high viscosity crude that wasn't light sweet crude, I bet they would have better finances. Their socialist government would have more time to delay, their inevitable collapse. So I think the finances of these governments would be better that produce oil at a higher oil price, but the global economy is getting worse. I don't think it can afford that. I want to talk about manipulation in the oil market. I don't think the oil market's a free market. I'm starting to see a lot of surprising signs from different areas, signals from different areas admitting this. Oilprice.com, which is, not a libertarian website, they actually ran an article a couple weeks ago talking about high-frequency trading algorithms manipulating the oil price much higher than it should be. Just this week, they ran an article, and the headline, I'm reading it now, is Oil Prices Fall as Hedge Funds Throw in the Towel. So, when they run these headlines on these articles, this to me means people are finally admitting that these markets are manipulated. The other part of the manipulated market, Steve, is the amount of dollars, credit, and shares that some of these uneconomic oil projects are getting. It's really mind-boggling that these oil companies, which can never make money, are still able to raise so many shares from Wall Street people because they can still grow the revenues. It's kind of like the technology stocks where the technology company would keep growing revenues but can't make any money. I feel that business model of fraud on Wall Street of selling, either debt or shares has translated over to a lot of these oil stocks now.
I agree, and I've had some interesting conversations with some people in the oil industry, and let's talk about conventional oil. These gentlemen go back years, and they've been looking for oil for 30, 40 years. And one gentleman told me he's actually done deals with Bunker Hunt back in the 80s. These were the original wildcatters, as well as the geologists that were looking for, let's say, high energy return on investment oil, conventional oil, which also meant high profitability. And he told me none of the wildcatters got into shale oil or gas. They all realized it's a Ponzi scheme. It really is a Ponzi scheme. And the only way that works, you see, you don't make enough money really to be profitable for the geologist or the investor, or even to help out let's say, the local or state municipalities' tax revenue. Because one thing people don't realize, it takes a fleet of trucks just to produce one shale oil or gas well. Well, it's destroying these roads in the counties across the country, in Texas and North Dakota and Oklahoma. And these local and state municipalities are realizing they're going to let these roads go to gravel because they don't have the revenue to repair them. So, again, the only way the shale oil and gas worked, that business model worked, was zero interest rates and massive money printing, which allowed public oil companies to make the shareholder the bag holder. So they got the financing, and they continue to get the financing through the banks, where they can continue to drill wells. There's a lot of money to drill wells and to frack wells, and we're not even talking about closing the wells in. But they're going to do 100,000 shale wells. Who's going to close them in? Lots of money to close them in. So I agree with you. I think the oil price is being kept artificially high, because if it was really allowed to let go, I think we would see the real gutting. We had a lot of bankruptcies last year on many oil companies. But if the oil price really started to fall, I think they're manipulating the oil price from falling, and they're manipulating gold and silver from rising. That's because the oil runs the system. And so I think if the price of oil really fell again back to the 20s and 30s, it would gut a large percentage of the U.S. oil and gas industry. It really would. So I think they're doing it just to keep the system going.
Rick Rule, early in his career in investment banking, he financed a lot of oil companies, and then he started his own firm and went into financing miners. He still does some oil and gas deals, but I'm not sure if you heard about this, but he gave a keynote speech at CDAC a couple months ago, and he said the high yield energy debt market is now worse and larger than the subprime housing market was. So he says there's over $1 trillion in total debt. That's from oil companies that can never pay it back, and he thinks there's a lot of derivatives that are tied to all these as well.
Yeah, and you know why this is bad? Because someone asked me, what's the difference today and 2008? Well, in 2008, we had a lot of seriously wrong things going on, like you mentioned, the subprime home housing market, and then we had a lot of crazy things. The auto industry was peaking, and just a lot of crazy things going on. Well, it's even worse now. It's even worse because the auto industry is like the subprime home industry, housing market. And also, I think last month was a record median average home price in that state, even higher than 2007. So we're seeing that. And then, of course, the economics, the revenue, the earnings for the S&P and Dow Jones have been about the same for the last 3 years. But look at their indexes; they're going towards the moon. Now, those were bad in 2008. The economics, the indicators were bad. A lot of them are much worse. What's worse than that, the energy sector is in much worse shape. Like I said, in 2007 and 8, they were making money. And they were actually making money when the price of oil was $30 and $25 and $40. They can't make money now, 45. Not really. So this is the issue. The economic indicators are in bubble territory, and the energy sector is being gutted like it wasn't back in 2008. You put these two things together, you get a perfect storm for a real market crash.
Yeah, Steve, you know what's going to go first? Because I think, Wall Street is either Wall Street or the Saudis with manipulation. They can easily hire an investment bank or hedge funds to manipulate the oil price. I think, the Saudis or OPEC are doing it for sure, or Wall Street was hired to do it, or they're doing it on their own. What's really worrisome, I think the large bankruptcies looks like it's going to come in deep water because they haven't been able to cut their costs. It's a higher cost type of oil production there. Yes, you can have long life wells, but you need oil above 60, 65, routinely above those prices in order to produce economic deep water. So your Petrobras in Brazil, Petrobras, there was an enormous amount of scam and fraud there of money and loans. When the oil price was much higher, the politicians in Brazil were using Petrobras as a piggy bank, and they were taking out money. Like those wells are going to be nowhere near as productive as the projections they gave to raise, hundreds of billions of dollars for Petrobras. So I think the deep water industry looks like it's going to be the first part of the oil industry to probably go bust and go bankrupt and consolidate and discharge their debt. But yeah, the other ones are not far behind, but it seems they're being propped up even with a lower oil price by some entities.
Yeah, I agree. And to give us, you see, I look at the energy return on investment. A lot of people don't really understand what's going on. They look at it in financials and they look at production. They go, well, look at it. The world is producing a record amount of oil. Yeah, but, producing, 90 million Fiats, let's say not Fiats, but Yugos, which are these really crappy Yugoslavian cars. You could get them for $4,000 compared to producing, 60 million Mercedes. You see, we're producing a lot of crappy oil, and it's really not, the energy quality in it is not that high. And so back in the 1970s, the U.S. oil and gas industry was producing 30 barrels of oil for the energy cost of one. Now, shale is 5 to 1. You see, and that's the thing. Shale is 5 to 1. In the 1920s, the U.S. was finding 1,200 barrels of oil for the cost of one. The last time they did the data was in 2010. It was 5 to 1. I would imagine now it's getting like 2 to 1, maybe even less than that. So this is an ongoing trend. This is bad news because the U.S. economy needs something probably north of 20 to 1, 20 profitable barrels to run everything. It takes 10 profitable barrels just to run the U.S. highway system, interstate highway system, and our agricultural processing and distribution to get food on the dinner plate. We need 10 profitable barrels just to run that. You want to add in the military, you want to add entertainment, healthcare, education, whatever. All those take the profitable barrels. We need 20. Now, when you're running shale at 5 to 1, it doesn't pay the bills the U.S. needs. So we import cheap or higher energy return on investment from other countries, and then we add a lot of debt. And this is the reason why we're seeing a lot of debt in the world, especially the United States. The debt is being used to offset this falling energy return on investment, especially of oil. And it's just going to get worse. And when it gets to a point where, you see, even though it's 5 to 1, that's out of the well. You have to transport it, you have to process it, you have to refine it, then you have to transport it again. And then it falls even further. It costs more energy to get that to process that oil and to get it to the market. And so now there's not much profit there, Jason. This is why we're seeing this kind of, I call, energy going at a business sale. They're producing as much as they can. I think we're going to witness what is known as the Seneca Cliff. And Lucius Seneca was an ancient Roman philosopher, and his chart shows that the way to growth is slow but sluggish, but the way to ruin is rapid. So the chart looks like a shark fin. It goes up very steep, and then it goes up slowly, and then it comes down steeply. And I think that's what we're going to experience. And so this is the reason why, and we'll try to get to it, I am a big believer in typical gold and silver, because most stocks, bonds, and real estate base their values, especially their inflated values, on burning energy. Gold and silver don't need that. Their energy, economic energy, has already been burned, and it's stored in that coin. So in the future, you don't want to be in most stocks, bonds, or real estate. And that's why I look at the precious metals as one of the few safe havens once we start to see this disintegration of the oil market.
Those are very interesting views on oil, and now we'll transition to gold and silver. So we're at silver. The silver price right now, I'm on Kitco at $16.82. The gold price is $1,256.90. Are these prices sustainable, in your opinion, for longer than a short period of time?
It depends on the analysis, depends on the analyst. The reason why, and I wrote an article, who really controls the gold price. And what I did is I took the price of Barrick and Newmont, their total cost of production, my total cost of production estimated. And from 2000 to 2016, the cost of production was always lower than the market price. Not quite much. Now, after the 2008 U.S. housing and banking crash, actually we start seeing a much higher market price than the cost of production. And I think what was happening then, Jason, was that the price of gold and silver was heading more towards its high-quality store value rather than its commodity price mechanism. Now, this is how I believe that the algorithms are trading and valuing silver and gold. They're valuing it as a commodity, its cost of production. And now, I did a breakdown of the top 6 silver miners last year, 2016, and this is what I got. I think Pan American Silver, their break-even was 15 and a quarter. Core was nearly $16. Tahoe was like a little more than 13, and Hecla was 15 and a half, and First Majestic was 15.80, getting close to 16. So that was last year, but that also included a much lower oil price, especially the first half of 2016. I looked at this quarter, or the end of last year, 2016. Their profits weren't as high. So I think the estimated break-even for the primary silver mining industry can still do okay at this $16, $17 price. They're not going to go under. But future silver production is going to be in jeopardy, mainly because we need a much higher price to bring on more silver production. But I think the decline of silver production in the future from global silver production will happen due to the gutting of the base metal mining industry, which is the production of copper, zinc, and lead, which produces 56% of all silver in the world. That, to me, is where we're going to see the most rapid decline of global silver production. When this market, the Chinese market, the U.S. market, the global markets finally roll over and really crash, we're going to see a lot of copper base metal production decline, and it's going to pull byproduct silver production down with it. So to answer your question, the primary silver miners are probably going to do okay for what reserves they have in the ground for a while, but they do need a higher price to bring on to replace their reserves or to bring on more production.
I agree with that. I think they can spread longer. They can't really take on any more debt. They've been working for the last 5 or 6 years on cleaning up their balance sheet. A lot of them had too much debt. They can't sell massive amounts of new shares. They can sell some maybe for a little bit of dilution to buy themselves some time. But I think, 5 years from now, Steve, a lot of the primary silver miners, they're not going to be able to replace reserves anywhere near the current silver price. We are looking, I think, at a $25 minimum 5 years from now, maybe even sooner than that, for primary silver miners and new silver mines to come online. I've looked at new projects. The only real new silver mine that could come online, Steve, in the next 2 years, I think, is the Mag Silver project, and Fresnillo, which is the world's largest primary silver miner, is their partner on that in Mexico. And that mine is one of the few ones that's economic below $20 an ounce silver. There's really very few silver projects that are left that are low-hanging fruit, that are high grade, low capex, low cost, low operating cost mines. All that stuff has been brought up. All of these mines that were the types of things I described with good grades have been basically brought online after 2008 financial crisis until now. So, and the miners, do you think the miners have done a good job, the ones that are in production on the primary gold miners, have they done a good job cutting costs to the bone since the bear market started in 2011, or do you think there's a lot more costs they can actually cut to lower their costs more?
No, I think when the price of silver really fell in 2013 and we got to a low 2015, early 2016, they did the most cutting they're going to do, and so right now, actually 2016 that we saw some nice decent profits for once, and Coeur d'Alene was actually showing net income losses for the last 3-4 years. But as finally they all started showing they're making some money. And the reason why they did that is the oil price collapsed more than 50%. That helped. Oil is a major cost, in producing silver as well as gold, especially gold. So no, I don't think we're going to see much more cutting. There's not much more they can do. They're close to the bone now. So the silver price, if it continues to fall, and it may fall initially during a market crash, but we have to look at the beginning of 2016, when the Dow Jones fell 2,000 points within a few months. We saw record retail gold ETF inflows, actually the most, except for one other quarter, and that's when the stock market was crashing in the first quarter of 2009, when Jim Cramer was telling everybody to sell everything, the world's over. We actually had nearly the same amount of retail gold ETF flows in a 2,000 point correction. Can you imagine when there's a 5,000 or 10,000 point correction? I see the price of gold and silver really moving up because there's really not much left to protect wealth. Now, you mentioned the mining industry. I wrote an article called "The Global Silver Mining Industry Productivity Falls to the Lowest in History," and we have to take this into consideration. The top silver companies, 7 of them, were producing silver at 13 ounces per ton in 2005. That's pretty darn good. Last year, it hit the lowest ever. After Tahoe Resources bought their Escobal mine up in 2015, it boosted it a little bit because they're a very high-grade mine. But last year, their production and their ore grades are falling. And now, it's down to 7.4, almost 50% less than what it was in 2005. So what do the primary silver mines have to do? They have to move almost twice the amount of ore that they did in 2005 to produce the same amount of silver. So it just costs more. Everything costs more. So I think we're seeing falling ore grades in the gold industry. They're basically mining gold dust now. We're seeing falling ore grades and yields in the primary silver mining industry. It's just more expensive. And it takes a lot of energy. And people need to realize that this is a very important factor. It takes 32 gallons of diesel for Barrick and Newmont to produce an ounce of gold. It takes only 3/10 of an ounce of diesel for Pan America Silver to produce an ounce of silver. So when oil becomes problematic, I think the primary silver mining industry, even though they're like no one knows about them, and they've been kicked around a lot, I think the primary silver mining industry, I'm going to go out on a limb and say, I think they're going to be one of the few places where we're going to see a massive inflow of investors, because it takes very little energy to produce silver. Silver is a great store of value and money, as well as a industry. And I think when the institutions and investors start believing silver, because the market is really rolling over and they figure it out, they finally get present in our religion, I think the silver mining shares will be some of the most explosive stocks in the world. Now, I'm not saying it's a guarantee, but the logic suggests that this is a likely outcome when things really start to fall apart.
As long as investment demand for physical metal is strong, and doesn't totally collapse, because industrial demand for silver is actually pretty strong. It hasn't fallen off a cliff. There's still a lot of demand for solar panels right now for silver. Silver is being used into apparel, water filtration, being woven into socks and underwear and Under Armour type clothes, wicking, the moisture wicking. So there's and also medical advantages. So they're innovating silver in healthcare and apparel and water filtration. A lot of interesting industries as well, and that silver is really silver is actually consumed by industry. A lot of it each year is not recycled. But great points about the grades. Most people aren't aware of this, but go back and look at, mining company annual reports from decades ago. I'm not sure if all of them are online, but you can this paper. You can probably record annual reports from a long time ago. The grades that 1960s and 70s during the black gold market, 20, 30 grams per ton gold was common. Now, a lot of gold projects economic are 1 or 2 grams per ton. For silver, 100 grams per ton silver decades ago used to be the bare minimum. Now we're lucky if we get 30, 40 grams per ton silver. So the grades have come down a lot. The funny thing is, we talked about the grades of gold and silver declining a lot over decades. This is in the face of, I've heard from a lot of different experts that I look at this as well and speak to the mining industry. A lot of miners, Steve, have been high grading their gold mines and silver mines the last few years, just the same business. And so they've destroyed the long-term project economics of the mine. I tried explaining to this one of my friends over dinner about how when you set up a mine plan for a mine for 10, 15 years, you're not putting all the highest grades into the mine all at once. You're mixing it in with medium grades and low grades depending upon if the gold or silver price is higher or lower. Well, just to survive the bear market, Steve, I think a lot of the miners put a lot of their high grade in, and now their mine, which was projected to be low cost in last 10 or 15 years, now their mine's going to be much higher cost, and it's not going to last as long with the higher grades.
Yeah, I would agree with you on that, and it's just a function of economics. And I was looking at Barrick and some of Barrick and Newmont's mines, and we could see. I know Barrick sold some of their mines to raise capital, but their ore milling really drastically fell off in 2016. Even though their production has fallen, their amount of ore, so their yield increased a lot in 2016. So we're starting to see this, and again, I know what you're saying. Gold miners back in the day, like homestake miners, if you said I'm going to go after a 1 to 2 gram per ton gold mine, they're going to be glad at you. They would think you're crazy, absolutely crazy. But now it is the standard. And these haul trucks, like the Caterpillar 797F model, it can move 400 tons of ore. The thing costs $5 million. They go through sometimes 4 sets of tires a year to move the ore, and those things are like 50,000 each. So it's very expensive to do this stuff. And once the energy, again, I'm always on the energy. When the oil starts to disintegrate, it's not a matter of, someone could say, oh, there's a million ounces of gold in the ground, or 5 million ounces, but we have 5 million ounces of silver in the ground. And it's 3 grams per ton. Well, you still got to get it out of the ground, and you need the oil to do that. We don't have battery electric technology for these huge oil trucks. It doesn't work. It just doesn't work. So we're going to continue to see falling grades and more expensive prices because they have been high grading. So this really comes to what I call the best of both worlds. Or let's say we're going to have the Black Swan event. There's not going to be much to invest in. Believe me, stocks and bonds and real estate, especially real estate. Real estate needs a lot of people driving around to keep all this traffic to fill these buildings. Well, we're going to see a gutting of the market, and we're going to see traffic just decline off a cliff. And that's going to really gut real estate prices. I see real estate prices within 10 years going for anywhere between 10 to 25% of their value. I really do. I really do. A lot of real estate will lose 75% or more of its value. It's the same.
Maybe in terms of gold or silver, maybe all these countries together with coordinate, they keep everyone devalues the currency 9-10% per year perpetually. to delay the next financial crisis, and then the nominal value would go up, but in gold or silver terms, the value would have been destroyed.
Yeah, and again, people need to realize a stock and a bond and a real estate. Basically, let's say stocks, they're based upon the price, the share, and this is net present value. It's kind of like a time machine. You take future earnings and you put a stock price today. Well, that's based upon economic activity taking place. Well, how do you have economic activity? You have to burn energy. If you don't burn energy, the whole economy falls apart. So you have to burn energy, and the most important energy source is oil. It runs the whole market. It runs our just-in-time inventory system. So when the oil industry starts to disintegrate, and it will, you're going to see the valuations of most stocks, bonds, and real estate. They're going to implode because it's based on debt. I mean, I've said this several times. The U.S. debt in 1980 was $863 billion. It's now approaching $20 trillion. It's 23 times higher. The Dow Jones was 865 points at the beginning of 1980. It's now over 20,000, approaching 21. It's a little more than 23 times higher. Well, isn't that a coincidence? The S&P is up 21, and the U.S. retirement market is up 24 times since 1980. All of our stock indexes and our retirement market is up at the same ratio as our public debt. There's no coincidence there. So you should not be in a market or a stock or a bond or a real estate that's being propped up by debt. So when that bubble bursts, and it's not going to be, one may flow from out of stocks into bonds for a while, but all three of those asset classes, which unfortunately 99% of Americans who are invested in the market, they're invested in stocks, bonds, and real estate. They're going to get the hammer to them, and I see 50 to 75% reduction in the values of most stocks, bonds, and real estate within the next 10 years. So I can't predict what's going to happen next year, Jason. I can't predict what's going to happen in next quarter or in 2 years. But the ongoing trend, guaranteed, is the energy's going to fall apart. It's going to pull the system down with it. So to me, where you want to be into is in physical gold. Now, some of the mining shares are a good bet too. But I think the physical gold and silver are going to be things that are going to be the go-to assets. And that's I used to follow the silver industrial demand. It's important. But I think when the markets crack, when they really crack, the industrial demand won't matter. There's 2.5 billion ounces of silver, investment silver, that we can get our hands on, according to 3 different sources I've looked at. And there's 2.2 billion ounces of gold. So when you look at the two, there's not much more silver than there's gold out there. Now, more can come into the market when scrap supply increases if the price goes up. But there really isn't much physical gold and silver out there. And that's why I believe when the markets crack, Jason, they're going to be the go-to assets. And who knows, the sky is the limit for the values of gold and silver could be.
There might not be a lot of scrap silver left to sell into the market. When silver got to 48, I heard a ton of scrap came into the United States into the refinery market then. So a good chunk of the total silver, that was people's silverware and their plates and other silver items, a lot of people scrapped it then. So I'm not sure how much we scrapped at this point. But yeah, I think, unfortunately what the central banks can do, a lot of it has to do with what the central bankers want to do during the next crisis. So, if they do want to let the asset prices crash, they can let the asset prices crash, and that would hurt Republicans in Congress. It would hurt President Trump. They could blame on him. Then what they could do is they could just start repeating everything again and move back up. And if they move everything up in nominal value, unfortunately, the incentive is they can make a ton of tax revenues moving these asset prices higher and higher and higher, like you said. That 23-fold move, that's responsible in a lot of parts for increasing government tax revenues, moving the asset prices like that. So if they can keep the real estate prices high by just printing more money and not to hedge funds or investment banks or people on Wall Street to go and buy these assets, they're going to make a ton of tax revenues doing it. It hurts the average person because people like you and me with the price increases, that's less things we can afford. But, the rich people who have access to, who can borrow borrow money cheaply and go out and buy assets, this benefits the government, benefits from inflation and devaluing their currency. But like you said, we might have this crash in asset prices. The only way to accurately measure that crash in asset prices over the long term might be gold, and measure how many ounces of gold it costs by how many ounces of silver it costs by how many ounces by Dow. If they continue to distort, it's not just the U.S., it's China, it's Japan, it's Europe. Everyone's trying to devalue their currency. So that might be the only way to accurately measure if asset prices are crashing, because they could be soaring in nominal value, would be measuring it in something more stable than fiat currency like gold.
No, I totally agree with what you're saying. And you see, the interesting thing there is, people said to me, Steve, well, if the U.S. energy industry is in such bad shape, why can't the government bail them out like they did the housing market and buy all the the crappy mortgage-backed securities? Well, they could do that, and it could buy a little time. Again, we always have to go back to the energy. Always have to go back to the energy. People forget that. Analysts look at the housing market, they look at the healthcare industry, they look at the auto industry, the stock and tech industry. We're very separate. Well, what runs all that? You take the energy out, all those sectors disappear. I mean, if you...
Steve, I think the Wall Street has already been bailing out the energy industry. I think you're already onto something. I mean, remember a couple years ago that story that the Zero Hedge about the Federal Reserve Bank in Dallas, the local bank. I think that's a bailout. I mean, maybe it's not the same type of bailout the airlines got or the military industrial complex got decades ago or the banks got recently, but that's still a bailout if you have these loans outstanding and you have the Federal Reserve telling the banks not to call on the loans. So I think they're aware of this, and I think behind the scenes they are already doing the bailout. That's why these projects like you and me have talked about earlier in the interview that aren't making any money, but yet they can raise, it seems, almost infinite amounts more. Wall Street helps them sell more shares to more sucker investors.
I agree. There's two things I can say about that. Number one, government can prop up with money and bailouts, but they can't print barrels of oil. And the falling energy return on investment continues. It's ongoing. It's kind of like aging. I don't care how much money you got. You're still going to die one day, right? We all die. Some people live longer than others, but the process of aging continues. And the process of the falling energy return on investment continues. It did in the Roman Empire, the falling energy return on investment, which it was a major factor that collapsed the Roman Empire. And it's the same thing happening now. While the government can do great things by bailing out and printing money, they can't print barrels of oil. That's the one thing. The second thing is, I lost my train of thought though, is that the oil industry is in big trouble because it's being propped up, and we have to remember if there's a debt on the energy company's balance sheet, or if they're borrowing money, what does that mean? People don't get that. Okay, they added $5 billion in debt, or $500 million in debt this year. They added to their balance sheet. But what does that debt mean? That means the oil company could not make money off of its oil. That's a perfect example of the falling energy return on investment. So what is happening? The oil industry is dwindling, is stealing, acquiring energy from other aspects of the economy to produce the oil. It's cannibalizing the system to get the oil out. So that's a bad deal, and that's why the U.S. retirement market the pension system is in trouble. We can't afford to pay the pension. We can't afford to really pay. There's no big bowl of gold at the end of the rainbow at a bank, in a retirement market, or a pension plan. It's nothing but a big hole in the ground. It's a big debt. There's nothing there. So that's the problem. And I'll tell you, I wrote an article on the U.S. retirement market. According to the data from the Investment Company Institute in 2014, that's the last time I did the data, Americans, the net withdrawal of their investments from 401ks mostly was $403 billion. They only put in $378 billion. It was a net withdrawal of $28 billion. Well, what is that? That's an implication that we're we're in the beginning stages or the ending stages. When you start pulling out more than you're putting in, then you're in the ending stages of the Ponzi scheme. It's not the 25 billion in there. That's just a digit. There's no gold they could sell to pay someone. So this is the problem. So unfortunately, the energy industry that's adding a lot of debt, all that means is the oil isn't paying for itself. So we have to steal energy or funds from other aspects of the economy just to produce the oil. Now, this is going to get even worse, and it's going to take the system down with it. It could fall apart within 10 years. It could fall apart within 5 years. I don't know. I'm not going to put a forecast, but over time it will happen. I say within 10 years it will likely happen. So that's how I see it, Jason.
You have a very interesting viewpoint on the oil market and how it deals with money return and investment in capital in other markets. The oil market is in my opinion, it is with the stupidity of politicians and governments and central bankers papering over past financial crises and getting off the gold standard and creating a derivatives market with too big to fail banks and not letting banks go bankrupt. So I'm not surprised that this has spilled over into screwing up other industries. The healthcare industry in the United States is screwed up too. There's so many different. The oil industry and the healthcare industry are the two largest real industries in the United States, other than trading pieces of paper back and forth with each other. So I think we're gonna talk about 5 years, 10 years for an energy crisis. I think unfortunately we'll have another global financial crisis in 2 to 3 years. Industry and maybe the derivative side to oil that, but it could also be so many other problems that are associated with debt problems and central banks and governments.
No,
because
I totally agree with you. When I say 10 years, the Oil Group did the EPP oil model, and they actually forecasted the price of oil. A bunch of oil engineers in Bedford Hill, what they did is they wanted to figure out, okay, what was going to be the price of oil, and they put all this information in, about 10,000 man hours, and it actually hit the spot, and it went up. And in 2012, interestingly, it started to decline. Well, the oil price really started to decline in 2014, and they have a maximum oil price that they have calculated using the EPP oil model. They took the average oil price for the last 40 years, and they superimposed it, and its accuracy was like 99.4%. It was very accurate. And so they actually were able to find out the cost of production. So it is on the short term, but when we look at it over the long term, the price of oil is based upon the cost of production. Same thing with gold, same thing with silver, same thing with copper. We go on and on and on and on and on. So supply and demand, the market innately balances supply and demand over the long term. I'm not saying over a daily or weekly or monthly basis. I'm saying over the long term. The market innately balances supply and demand. So what is the overriding price of a metal, good, or commodity? Is its cost of production. That's the overriding price is the cost of production. So now we're going to continue to see a falling oil because the value of the oil cannot generate the economic activity because here's the thing, the oil market, is the total oil market producing, processing, and distribution of oil, it's huge. It's just the oil companies, it's not the transportation, it's not the refiners, it's just not the tankers who deliver it all over the world. There's a lot of support people. Education, it's amazing how many people support the oil industry. Well, their customer is slowly going bankrupt because there's less and less net oil available for the customer, which is the market. At some point in time, and this is the 10-year timeline, in 10 years, it bankrupts. The market can no longer get enough oil to continue enough surplus economic activity. And so that's why I'm looking at a 10-year time frame. Now there's a give and take in there. It could be plus, it could be minus, or we could have a black swan event that takes the system down quicker. So I agree with you. I think the situation is going to unravel. It could likely unravel sooner than later, but the trend is we're going to be in a much different world within 10 years than we are today. And we'll never, like Peter Schiff, if he says we'll let the banks crash, we'll redo ourselves, and we'll start over. We can't start over. The Roman Empire didn't start over. Once it was done, it was done. The Eastern, I'm not talking the Western. Western, I'm not talking the Eastern Empire. And so the same thing is going to happen with the U.S. empire as well as the global economy. It's going to transition to something much smaller. It will never come back. We just don't have the available energy to run things like we used to. And so that's how I see it, and it's all based on the energy.